Hello everyone, a very warm welcome to you on behalf of ELM Analytics. We prepare this ELM level matrix for you every day. This is the Nifty matrix and this is the Back Nifty matrix. So in this video, we will be telling you how we prepare this table and how these levels or the possible themes for tomorrow are useful for the market. So first, let us look how we prepare the table. So here you see that the hourly averages are placed here and the values of the hourly indicators. CCI 20, RSI 14, the percentage K line of the slow stochastic, ADX, etc. And there are a lot of moving averages here. So first, let us go to the chart. Here you are watching the Nifty chart in the hourly time frame. Now once we click daily, it becomes daily. So based on these averages, we build this table and also we take the values of these indicators. Now all these values are quite important to us, and here we are giving you some important Fibonacci projections. So if I go here, this was this projection from this level to this level, this is projected, these values are given here. Now for tomorrow's date, maybe some other Fibonacci ratios would be important. The most important one we reflect in the table, but if suppose tomorrow we want to see another retracement, here I am clicking Fib retracement, and based on that I find okay, some level around this would be important for tomorrow. So we take into consideration in building the table this way. So we don't always actually write all the Fibonacci projections or retracement or extensions, but we build that in the numbers. The most important one we are giving in here. So similarly, we prepare the Bank Nifty table here. Now, one thing you should understand, these are based on Nifty and spot Bank Nifty. But when you are trading in the market, suppose in Nifty, the Nifty future, the FAVE contract is right now trading at 11058 and the underlying spot is 11027. So there is a premium of close to 31 point. Now this premium or the discount, they may vary from time to time based on the derivative positions, based on the open interest in particular calls and puts, based on the VIX level, everything. So we are not giving you anything that how this ratio or the difference between the spot and the future will be having its effect on the overall movement. What we are saying is that generally, if we can track the movement of the spot Nifty, which is actually devoid of this kind of premium or this kind of option discounts or open interest, if we just analyze the spot Nifty, generally we can track the Nifty future also. So based on the levels that is reflected on the spot Nifty, you can take your Nifty and Bank Nifty futures trade also. Now let me show you the table that we prepared for yesterday. This was the 31st January table. Now let us look at how the market behaved today. So let us go to the 15-minute chart of NSCI, that is the Nifty 50. Now what happened? The market opened the day around, this is the 31st, around this, and in the next within 30 minutes is formed the high of 11057. This was today's high, right? So if we can see, for today our resistance level was 1084, so it didn't go to that level actually. So it then came down and came down close to the level that we predicted was 1988, and the low was, today's low was made around 1980. So there was 8-point breach. So basically, when we are giving these supports and resistances, they may not be held on absolute basis, like 5-10 points aberration can be there. But the main point we are trying to make is that if a particular level is seen to be holding, then there is a scope that market may go to the next level. So first, also look at the Bank Nifty, how it happened today. Then we will go to some other details. Here you are showing the Bank Nifty. See, these are the Bank Nifty candles. For today, the Bank Nifty, the support level was given was 27138. What we could see is that the opening low for today was 27127, pretty close, 10 points in a 27,000 instrument, and there was an up move after that. And even when the market came down, it was close to this 130, 140 level. So apart from the first hour, the level that we have given was 138. Market was actually hovering around this. See, this was the low point, I think 144, and this was again the low point 143. So we had given 138. So market all the day were hovering all this. As the market was holding, there was a long trade could have been taken targeting the next level. So what is the next level that we have predicted on the upside? 27417, right? And see what was the high for today? It was 27445. So it even breached that point. So that is how the levels are important. So when you find a level in this parameter or in this probable support and resistance zone, you treat them with caution. And when you see that market is holding a particular level, and then there can be a pullback to the next level, or if a certain level is breached on the higher side, suppose 11,084 was breached, then the next target would have been 11,111.09, and if that could have breached, the next target could have been 11,143. On the downside, one breach of these levels, the next level was to come on. Now these levels are based on the end of day technicals of the previous day. So suppose today is 31st Jan. So at the end of today's 31st Jan, we are giving the levels for tomorrow, right? Tomorrow may be a gap up or gap down day. Suppose tomorrow the market opens above 11082. So if 11082 is actually taken out in the opening, or the market opens above that, then this level becomes the next support level. Or it even after a fade move or something, it opens above this, then this level also becomes a support level. Suppose due to a very bad news, market opens gap down and it opens below 997, then this level also becomes resistance levels. So these are support level, well and good, but if there is a gap up or gap down, these levels become respective support or resistance levels. Like what happens in market, the previous supports get resistance once that is breached, and previous resistances get supported once they are breached. Now one thing I would like to show you in the daily chart. See, this is the 5-day high EMA, this is the 5-day low EMA. So once the market close is happening above the 5-day high EMA, it continues for quite a few time and there is a very sharp up move. If you look at the market in past also, when there has been closes above this 5-day high EMA, the market has moved quite higher. Let me go back in history also. See, all these moves are actually with the market closing above 5-day high EMA. So basically the theme that we write, the bullish or bearish, whatever we are writing here, are based on if the market is closing above the 5-day high EMA, it is termed as bullish. On the other hand, if you see all these down moves, the closes were below the 5-day low EMA. This is the line 5-day low EMA. So if the market has to go down very sharply or on consecutive days, I will look for a signal that market is closing below this 5-day low EMA. And once that is happening, that is an opportunity to actually maintain a short or remain in the short. Or suppose we are in a phase when the market is closing below 5-day low EMA, and we find that a certain level or support level on the next day is broken, then actually there is a reason to go short because market is likely to go lower. But look at this phase or this phase when the market is closing in between this 5-day high or low EMM, then the market is overall flat. At that time we describe that Nifty or Bank Nifty is flat. Like for yesterday, if you see that the 5-day high EMA was 11,005 and the 5-day low EMA was actually 5-day low EMA was 11,005 and 5-day high EMA was 11,084. So those were the markers in our table. But apart from that, we also mentioned, based on our understanding of the market, if it is going bullish and bearish. One more thing I would like to show you, the most important borderline in an hourly chart is the 20-hour moving average. So if the market is holding this level, it keeps on goes higher and higher. On the contrary, if the market is consistently closing below this 20 period or 20-hour moving average, the market normally goes lower and lower and lower. So that's why entire the bullish, bearish or range bound thing is mentioned based on three major factors. One is 20-hour moving average and 5-day high EMA and 5-day low EMA. So these are the levels that we mentioned, and we described you how you can use them effectively in your overall trading. Hope you like this video, and thank you very much for watching the video.